Alright guys, welcome. If you're coming from the long portion of the video, I'm going to try to go through this quickly. What you're looking at here is Fast Graphs. It's a fundamental software analyzing tool. I really like it. What we have here in front of us is Carnival Cruise Line, ticker symbol CCL. I covered them in a previous video, so I'm not going to get into all the details here. A few things I want to point out. So from this period of early 2018 to late 2019, you see there's a depreciation in stock price by 40%. Now, there's a lot of reasons for that, why that happened. But what I want to point out here is that during this period that the earnings actually went up. So you have a stock that's getting cheaper on a price basis, but it's also getting cheaper relative to its earnings. I love when that happens. Those are buying opportunities in my opinion. And I started buying this stock in the 40s and started to make some money on it. But then this happened, and here we have another drop in the stock price. This time it's 45%. The difference being this time, this drop will actually reflect the earnings. This light shaded green area are earnings that are projected. So analysts that were already projecting for 2020 for it to roughly be flat, down 1%, with 2021 and 2022 having double-digit earnings growth. Now, these earnings haven't come down yet, but they absolutely will come down. It's not reflected in this graph yet. So this response back here, not reflected in the earnings. Now we have this another huge drop, approximately the same percentage drop, and it is going to be reflected in the earnings. Now, what remains to be seen is this an overcorrection? Is a market overreacting to what might happen with these earnings in the future? I think the answer to that is yes, but you never know. You're not going to know till later this year or next year or maybe a couple years from now to really paint the picture whether this was a good opportunity or not. I'm betting that it is a good opportunity. So back here, you could argue that Carnival was, fair value. It's trading just above its normalized PE for this period. This blue line is a normalized PE. And then since then, we've had a drop of 61% in the stock price, while, as said earlier, the earnings have actually gone up. Kind of flat, though, in this period, but have gone up and are expected to go up in the future. I still think 2021 and 2022 are good. Maybe 2021 less so, but 2021 and 2022 should be good. This year is going to be rough. Again, I think the bet here is that this is an overreaction and that there's, double-digit annualized returns here in the future. If it went back to this normalized PE, if these earnings projections were correct, you're seeing massive gains in the stock price, and you're getting a dividend yield at 7.18%. It's pretty impressive, and the dividend is expected to grow at about 5%. You see projected for 2022 is $2.20. It's currently $2. Again, Carnival Cruise Lines is obviously a cruise line company. They also have hotels and resorts. In regards to the coronavirus, this is the exact type of company you wouldn't want to be during a coronavirus scare. Maybe worse is Disney, and I'll get to that in a minute. But again, if you believe in the long-term fundamentals of this company, then this seems like a good opportunity. I just want to point out one more thing before we move on. Here is the same chart I just zoomed out. The cheapest this stock got during the Great Recession, January of 2009, we're looking at right here. The price was $18.19. The PE was 6.52. The price earnings ratio is 6.52. You're getting it less. It's cheaper than it was in the Great Recession. The price is almost $28 right now, but on a PE basis, it's the cheapest it's ever been. Even here after the .com bubble, you're looking at 11.5. So great value right now, great dividend yield. I think that holds. However, if there's a credit crisis, going back to the Great Recession here, you can see this white line is the dividend. It was going up nicely into the Great Recession. They cut it, and for good reason, and they reinitiated it here in late 2010, and it's had nice it's had nice dividend growth through this period. So this company, it's capital intensive. If this coronavirus thing escalates into a credit crisis where banks are no longer lending money, people maybe lose their jobs, or they're not making as much money as they were, and they're not going on vacations, you're going to look at trouble with this dividend in the future. I don't think we're there, even though there will be a hit to earnings this year at least. I think the dividend is relatively safe. All right, that's enough with that. Let's move on to the next company. And I'm going to do these in alphabetical order. So this was CCL. What's next? Disney, I think. DIS, yeah. All right, so here's Disney. Disney has a category here as a media conglomerate. Disney's known for its parks. They have a cruise line. People fly from all over the world to go to Disney. People are scared to get into planes right now, and flights are getting canceled left and right with the coronavirus. So Corona hits their park business. It hits their cruise business for sure. They make a lot of money from their movies. A lot of people are probably scared to go in theaters right now as well. The only thing that's good for them is their new streaming service, actually. So I want to talk about that a little bit. Let's zoom into this chart. I'll cut time off the graph here. I just want to show this. So this is mid 2015 to early 2019. The stock was flat. The price down 7.5%, but when you factor in dividends, it was down less than percent annually. And you can see that the stock traded in a range here. I'm cherry picking here a little bit. This one I want to show you guys though. This huge spike here was the announcement of the streaming service, Disney Plus. From that point to the peak before Corona started taking over, you had a 36.5% increase in the share price in a pretty relatively short period after having years of it trading in this trend. And what's interesting is we're basically back at those prices. We're back at the pre-streaming service prices. So yes, Disney is going to definitely be affected by the coronavirus. For how long, I don't know. But people aren't jumping on planes. People aren't jumping on cruises for a good reason. Oh, and Disney owns hotels too. So there's another thing. So hotels are problematic as well right now. But Disney is a great company, and you're buying it at the pre-streaming service prices. So I don't know how sold I am actually on the streaming service, but the reason why I had this huge jump is the market loves subscription services. It's not going to be capital intensive in the way a park is, or cyclical the way a park is. It's easy for people to pay a monthly subscription, sit at home, and Disney just makes money. The reason why this is interesting to me is, and here, let me take some time off the graph to illustrate this better. So Disney was trading at a PE of about 17 and a half for this time period, and actually that's how they've been historically, absent the .com bubble, where they were, like many other companies, very overvalued. So that normalized PE would be higher if I included the .com bubble in this graph. But the point is, they've been trading for a long time about 17 to 18 PE with periods of real high overvaluation, and then if you're lucky, some periods of lower evaluation. Here it looks like its valuation is really high, but I think this is a new multiple that the market is assigning to this company because of the streaming service. We'll cut this time off again. You got a PE here of 21 to 26. I think that's going to be the new range. Once we get past this coronavirus moment, which again, that just brought us back to where Disney was. So you're buying Disney pre-streaming service prices right now. I think that's good. Dividend yield, not great, but they are growing it. I think it's a great company. I was invested in them through here. I wish I owned more shares before this jump, and now I'm getting the opportunity again, so I'm buying into them. All right, let's go to the next company. All right, this is a Royal Caribbean's chart, ticker RCL. Again, this is another company that I just went over in a different video. Check that out for more details. It's mostly pre-Corona. I think Corona was starting to come in the headlines, but we didn't see the price action yet. So check that out. Just know the proper context. Come back here. I really like RCL. I like it a little better than CCL, but just hit so hard. They have the same issues that CCL has. So again, if there's a credit crisis, this dividend is probably not safe, but save for that, you're getting a current starting dividend yield of 4.75. The compounding annual growth rate for this dividend has been 12%, and if you just look at since the Great Recession, where they cut it, the earnings dividend growth rate has been substantial. We're looking at more than 20% a year. If they can keep that up, who knows if that's possible. Your yield on costs, 10 years from now could be very, very substantial. Capital appreciation, you're looking at 186% if, the stock could return to this normalized PE based off these analyst projections on earnings. Again, just like Carnival, this year, these projections are going to be rich. I'm looking at negative earnings growth, not negative earnings, but negative earnings growth. This green bar is going to come down a lot. Peak to trough here on the Corona fall, you got the stock lost half its value in a pretty short period of time. You're getting a PE of 6.86 right now. What was it during the Great Recession? Oh, it was super cheap during the Great Recession. But look what happens when you buy at that price. Cherry picking, of course, here, but 34.3% annualized returns, and that's without a dividend during a few years here. And another thing to think about, that 34.3% does not include reinvested dividends. I think it's always important to factor that in. I'm going to cut time off the graph just so you can see how the earnings have looked more recently. Again, I think cruise lines have finally gotten their act together, and they're actually a pretty good business model. You have operating earnings of 21% during this time period. Again, I always like to buy companies like this. So you get the share price, $101 back in 2015. We're now at $65. That's a negative annual. I don't know what to annualize because this is including dividends. The share prices fell 35% during this multi-year period, while the earnings have gone up substantially. And I think the earnings long term will continue to go up substantially. Not this year and maybe not next year. But I'm a long-term investor, and I think this is a really good opportunity. One thing to note, I forgot to mention in the other for the other companies, the credit ratings and the long-term debt to capital. I was going to go over EV to EBITDA as well, but I forgot. Anyways, 37% long-term debt to capital. I think CCL is less than that. And I think CCL's credit rating is also better, but forgive me for skipping that. Trying to blast through these. All right, let's go next to Spirit Airlines. All right, this is Spirit Airlines. If you're not familiar with them, they're an airline company. They're like the affordable, cheap airline. I've flown on them before, and not the best experience in the world. Definitely your value airline. But I love their earnings growth. And again, it's one of these companies that I love the earnings growing while the share price falling. To me, that just creates opportunity. These are buying opportunities for me. Again, the caveat here is that these projected earnings not going up like you see here. It's going to be negative for this year anyways. Well, beyond that, I don't know. Long-term good. Again, if there's a credit risk, they're going to be in trouble. Probably more so than the cruise lines. You've got a credit rating that is less than investor grade. Long-term debt to capital, 54%. Not great. Also, this company doesn't offer a dividend. They might in the future. I don't know how that could be years from now. A lot of airlines offer dividends, and we're looking at operating earnings here, but they've got good cash flow. So I'm going to just change the chart to operating cash flow real quick. Yeah. So operating cash flow growing pretty quickly, 34% here. I think the operating earnings were growing at like 22%. Yeah. So I like them. It's more spec. I don't have a lot of money invested in Spirit. I don't plan on putting a lot of money in them, but they're attractive to me right now just because of Corona, really. If you get a reversion to the mean, you could have substantial growth in their share price here. Again, it's not a dividend company. If that's your cup of tea, this is not it. I'm not invested in Delta. I'm not invested in Dell or Delta, but I do want to just show them really quickly so you can see if you're a dividend person. Here's Delta. On Spirit's chart, we didn't see the Great Recession because they weren't public back then, so we didn't have that data. But you can see airlines did not do well during the Great Recession. Their credit rating is better than Spirit's, and their long-term debt to capitals is better. Again, we're looking at operating cash flow here, so substantial operating cash flow over the dividend. Dividend seems safe. Like I said, we have a credit crisis, then it's not going to be safe. It's definitely not going to be safe. But I think risk brings with it opportunity. This looks pretty good. Let's cut time off. I just want to get it more reflective of comparing it to Spirit, not getting the same operation cash flow growth rate. Okay, I switched this to operating earnings. Growth is good. Projected growth is good. They're not projecting any growth for this year. I don't know if I don't pay attention to this company, so I don't know if estimates have already come down or not, but I would not expect earnings to be great this year. They've been hit pretty hard with Corona, and the fundamentals are going to be hurt this year. Long term, I don't think so. That dividend growth rate looks pretty good. Let's check out the performance chart. Yeah, so the compounding growth rate for the last 6 years has been 52%. That's because the dividend started from zero. So if you X this first part, I mean, you're still getting substantial growth. It was 15% in 2018. I'm not about to do the math on this, but I think that's slowing down. Just looking at this chart, if there was no, if Corona never happened, then I presume you're getting double-digit earning or dividend growth rate for this company. And the starting yield is 3.5%. All right, let's move on. We just did save. Let's do SPG. SPG is my last one, I think. All right, yeah. SPG is a REIT, a real estate investment trust. I've talked about them in the past on previous videos. You have to look at operating cash flow. So I'm going to change this to operating cash flow. You need to use operating cash flow for all REITs. That's the go-to metric for REITs. One thing I want to point out is the long-term debt. It's 80%, the long-term debt to capital. On the face, that seems very high, but it's a real estate company. Debt is sort of the product. And we are in low interest rate environments. Debt's getting cheaper, so REITs look good right now. And this is a company that comparing it to the cruise lines that they lost their dividend coming out of the Great Recession. SPG held on. They kept paying. Though you see the dividend dipped. It went from $3.31 a share all the way down to $2.44. But it never went away. And then in a couple more years, it was back up over that pre-recessionary time. And it's grown quite nicely. Again, if there's another credit risk to the market, the dividend, I would say it's safe, but you're likely to get a cut for a few years. It's another company that's been beaten badly. It's got that, the negative growth to the share price while the earnings are actually growing. I love that. And here more recently, you've had this huge decline from the coronavirus. One thing to point out, this isn't just a REIT. This is a mall REIT. And that makes it even more scary because the whole retail apocalypse, Amazon taking over. But one thing I want to point out is this company has continued to increase their earnings even through this whole Amazon era. And that's because their portfolio is very high quality. If you go to their malls, they're still doing quite well, obviously. I just wanted to zoom in to get a more near-term picture. So see, the blue line is this normalized PE for this period. It's obviously been trading under that for a number of years. Obviously, people are not congregating in malls right now. Like hotels, cruises, airplanes, malls are another place where people congregate, and hence the corona impact here. So because it's a REIT, they're collecting money from their tenants, and their tenants are companies. Those companies are going to make less money, but that doesn't necessarily translate to less rent for SPG. Now, if they lose tenants, that hurts them. If they don't lose tenants, but their tenants lose a lot of money, they can renegotiate lower rent, so that's a risk. However, I don't think this drop is, or for that matter, this drop here reflects the reality of the situation. I think this is long-term a great company. How long it takes us to get back to this normalized PE, I have no idea. It's going to take a little longer now because of the corona, but I think you've got a lot of potential growth for this company in the future. The operating cash flow growth during this period has been nearly double-digit. You're getting a starting dividend yield of nearly 7%. And the company has been growing that pretty quickly. Double-digit earnings growth the last 8 years. Let's check out the all chart. All right. So this is going back to 2000. Yeah, you have near double-digit for this 19-year period. You have near double-digit earnings growth. Dividend growth. The dividend payout ratio, 60s, 70s. That's completely normal. Actually, it's a little low for REITs. They generally pay a higher portion of their income back to their shareholders. That's for tax purposes. I want to check the analyst scorecard. So analysts have been very, very accurate at projecting the earnings growth for this company. And again, lighter shaded green area is the projected earnings growth. Again, this is probably coming down if they haven't already lowered guidance on this. Though I think they're at less risk than, say, the cruise lines and Disney for that matter. So yeah, you're buying this company for a nice reversion to the mean play. Whether it happens this year, next year, the one after, I have no idea. But in the meantime, you're getting 7% yield. It should continue to grow just as long as we don't have a larger credit risk. Well, that's it, guys. Tell me what you think in the comments. Which of these, if any, of these companies are you buying? I do want to know, are there other thoughts you guys had? Are you looking at the names that have been beat up a lot, like I am, or are you looking for companies that are maintaining strength during this corona time? I don't know what the best strategy is. I don't have any idea, and I don't think anyone has an idea of what are the best companies to buy. Like I said in in the other video, I think buying a broad index fund is probably the best. It's certainly the safest bet. But I think substantial returns when you buy these companies, they're just destroyed. I think the reward is worth the extra risk, I think, in these names. But that's to each their own. If you're an older person, I'll let you define how old is old. You may want to stay away from risk like this. But if you're in your 30s, if you're in your 20s, oh my God, take some risk. Even if you're in your 40s, damn it. But all right, guys. That's it. I think if you have a well-conceived long-term investment strategy, then buying, regardless of the macro trends, actual or perceived macro trends, is the correct strategy. None of this is financial advice. I'm just an idiot on the internet with a lemonade stand. I'm long everything mentioned in this video. Well, maybe not. I don't know. I'm long SPG, SAVE, RCL, CCL, DIS, and even Tanger, though I did reduce that position. That's it. I'll see you guys next time. Peace.